Hello and welcome to the Madison Podcast. My name is Ben Lavender, New York's favorite British mortgage broker. I have another very special guest, handsome fellow as well, Mr. Michael Ramin. Michael, please introduce yourself, even though I just kind of did.
All right.
Tell everyone who you are, what you do, and why you are such a G.
All right, awesome. Ben, thank you for having me. Michael Ramin, I am the Executive Director of Sales for Sharestates. We are a national direct private lender based in New York. And here with Ben Lavender.
Exactly. So, Mike, we've known each other and done business with each other for a while. You, I would say, represent a different side of financing. And I know that you have other ventures that you do as well. You're into title and a few other things. Can you tell us, like, what is your bread and butter? What are you amazing at? What do people know you for in the business?
I think what we're amazing at is helping investors grow their business. So when we started in the business, we got into the fix and flip investor space about 10 years ago. And the whole idea was if you're going to grow an investor's business, you want to kind of graduate with them. So if a borrower is coming to that fix and flip space, and if they go exclusively to a fix and flip lender, sometimes after they get into mixed use, multifamily, ground up construction, heavier rehabs, other products, if they're not available, you kind of lose that relationship that you built for several years. We've graduated with our borrowers. So as they got into the smaller multifamily, we went with them. They got into mixed use, they got into office, they got into retail. We were able to kind of grow our program and platform so we can grow with our investors. And that's been pretty cool.
And yeah, I don't know really many companies that operate that way. I feel like you have kind of a niche. I wouldn't say a monopoly, but you've that specialty, especially in the past maybe 2 to 3 years, the demand has been tremendously high. What type of trends would you see have like at the beginning of COVID, as far as investors went? What trends did you see, and what's starting to change, if anything?
All right, so yeah. Absolutely. Beginning of COVID, I think first COVID hit and everyone got scared, and then they realized housing shortage, low mortgage rates, and that's when it started to spike. So on every property type, fix and flip, those, people can find them, or if they're distressed situations, you saw people were moving. So if they wanted to leave New York to go to Florida or whatever, they were selling their homes at discounts to get out of there. And the rates were low. So historically, when we got into the fix and flip and, some people call it hard money space, whatever you want to call it, rates were that 10, 12%. They were down in that 7% range. Mm-hmm. So it's a 5% swing for financing is a big number.
Yeah.
So the demand skyrocketed and there was money in the industry for it. So it kept going. I think today, there's a little investor, I want to say fear of the market, because there's still a massive shortage on homes. But people are a lot more selective when looking for deals. They want to make sure there's larger spreads. The rates have gone back up into that double-digit range. So you're seeing the fix and flip and investor loan rates back in that 10-plus range. Okay. So you see demand has gone down a little bit, but people are still trying to find deals. I think foreclosures will come back.
What are rates like for DSCR, long-term holds?
So DSCR long-term holds, you're seeing similar to how they were when COVID first hit. So when COVID first hit, before actually COVID, they were in that 4.5, 5 range, and then they went down during COVID all the way to 3.5, 4, and now they're up to that 7% plus. So you're seeing 7 to 9%.
It's not terrible. I feel that's on par with conventional, at least in the 7s.
Yeah, in the 7s, you're getting good deals. It's not getting tied to your personal credit, so you could take as many. If you have 40 rental properties, you can get 40 separate loans.
Awesome.
So it works out well.
That's something that a lot of people struggle with.
Yeah.
Especially the more seasoned investors. Would you say that you specialize with more seasoned investors, or newer, or you feel like you do both?
I think a little bit of both, but definitely more the seasoned investor. We don't have concentration limits, so we have a lot of borrowers that come in and they have certain goals and we help you hit it.
And I feel like your guidelines are new investor friendly.
Yeah, right. Absolutely. I think they lowered leverage recently because of just how the market is with newer investors, but still helping people get into the space. If you've done 1 or 2 projects and you want to kind of grow it, work with the borrower, get them financing, make sure they're going in the right direction too. We don't want to see a borrower fail. For us, a borrower succeeding is great because they come back as a repeat business. Gotcha.
Okay, so here's a question, because a lot of people that watch this, it's a lot of agents, it's a lot of loan officers in the business who want to get into investing, right? Either fix and flips or long-term holds, or maybe use one to go into the other. Where would you tell them to start? Because they're in the business, they have a knowledge already, but what are like the first steps that people wait too long to do, if there are any?
I think absolutely. I think one of the first steps is failure to it's like the fear of failure. So I think it's very important, regardless of what you're going to go into, make sure you have the knowledge of the area. If you know very well about single family homes and you know a certain area, look in that area. You already know the market. Take a look. But I think it's first to get educated. If you're going to do construction, go to the building department, make sure plan approval and everything is going to be seamless. So it's something easier and you're going to have knowledge with, and you're going to know the area. You know you're going to get it approved. So to mix of that, if you're like larger projects or bigger projects, maybe work with a mentor on your first deal. Work with someone that has experience and get in with them. Have them come on with your first deal. You know, it's worth paying someone a fee to get their experience and knowledge in on it.
100%.
So I always work at that. And then realtors, I think it's big because they see deals all the time, and they see them first. So a lot of times they don't know that there's financing available for them to actually buy that deal and move it. They might not have the construction experience, but I've seen a lot of realtors partner with contractors.
So what does that typically look like from a structural perspective?
Like on a fix and flip loan?
Yeah, for instance.
So fix and flip loans, typically you'll get borrowers anywhere from like 75 to 85% of their purchase plus 100% of the rehab costs. That's typically done in draws.
That's great.
Yeah, on reimbursements. And
yeah, let's walk us through that, Mike, because I think that's something very valuable for people to learn. Like, how does the draws work? How is the LTV decided? Right? Is it credit-based, experience-based? Like, how does that all thing work?
So we'll start with LTV. LTV is decided based on borrower's credit, experience, so how many flips they've done, if like 1 to 3, 3 to 5, or 10 plus in the last 2 years.
Okay.
It's tiered definitely on that. They'll look at credit also. Definitely love borrowers to be like 680 and higher.
Mike, how do you prove the flips that you've done?
So we're able to verify them. So our technology is great. A borrower comes in. So we used to use a name like Bob the Builder, just rhymes. Yeah, but we can use Ben the Builder now. So
no, Bob sounds better.
So you got Bob the Builder, and he comes in and he says, I did these 3 flips with technology today. If it's in New York, you can look on Acris. If it's anywhere else, use like DataTree, other technology to find out they've done it. If they close an entity, just ask them for copies of their operating agreements, and you create it. First time I verify a borrower's track record, I don't need to do it anymore.
Because I'm sure you get people who BS it, right? Who are like, yeah, I've done 10 and they've done 0.
Yeah, you get caught.
Yeah. So don't waste time.
Don't lie. Yeah. But you kind of do that. But on the next deal, now I verified Bob the Builder's track record. So I don't have to do that again. So that's in our system. We have his ID that's in there.
And it makes easier for people to come back to you as well because it's seamless. You have everything.
Yeah, if they're using the same entity, I have your entity doc. So all I need is your contract, your rehab budget, and, like proof of funds that you have, like, the money to close. And that's it.
Sweet. Okay.
And insurance.
And back to the draws, Mike, how does that work? In terms of, for the rehab, for instance, if you're doing 100%.
Draws are simple. They code your budget into your appraisal. And once you start doing work, it works on reimbursements. So typically you get anywhere from 1 to 8 to 10 draws, depending on your project size. We do simple fix and flips where someone's doing maybe $30,000 to $50,000 worth of cosmetic work. You have people doing larger budgets like $100,000 to $200,000, a dormer in a house, extension, anything like that. And you got larger projects ground up.
But you're saying it's reimbursed, so
Bob the Builder goes in there. He closes on the property. He's got let's just say $100,000 budget. He goes in and starts doing work. So now he does demo. He rips everything out, and then he orders supplies that come onto site. So now he spent, let's just say, $15,000 on demo, $15,000 on his roof, and like $10,000 on supplies. An inspector comes to the property, they verify the work was done, they get a lien release from their contractor, and they're able to wire the money to them within 24 to 48 hours.
And in terms of timeline, like how long does that typically take?
Draw process from like submission to wire is usually 7 to 10 days.
It's not bad at all.
Not bad. Yeah. You can do it quicker also. A lot of people that master paperwork, they just know full package to submit. It comes in. It is a lot quicker.
But I imagine that's not what it looks like typically. Most borrowers, especially if you're newer or contractors, aren't known for their ability to handle paperwork.
They've gotten a lot better. I think our process where they're filling out the coded budgets in advance, it's kind of just checking off what you finished, so it's a lot easier, and submitting one form. In the past, it might have been harder if you had to fill out a lot of paperwork. We've used technology and the upfront process to help later on within their loan.
Gotcha. Okay, and you were about to go into, before I interrupted you, go into ground up, because that's a question I get all the time, both for primary residences, which from my understanding is very challenging in New York, and feel free to correct me if I'm wrong, as well as investments. Like, how does ground up look?
Ground up is great. I mean, investors, we won't do primaries, but we'll do investors building, whether it's on spec or they're doing subdivisions, finishing their horizontal, able to get plans approved and build on multiple lots at once. But you're typically getting borrowers anywhere from like 50 to 70% of their land, sometimes higher based on experience, and up to 100% of their construction cost.
100%?
100% of their actual build cost.
Wow.
Total loan amount can't exceed 80 to 85% loan to cost.
Got it.
And you want to keep the total loan amount, under 70% of the future value. Typically on ground up, you're hitting those numbers. You should be fine.
Yeah.
And that's actually one of the markets that investors have been very bullish on. So you see their build to rent space where they're building single family homes based on the shortage in the market to rent and a lot to sell. So they're building to sell, and communities will do a split.
So out of curiosity, where are you seeing a lot of these ground up deals taking place? Like out of state? I'm trying to get a feel for everyone. Like where should we go to invest?
You're definitely seeing out of state. So you see like places like in Tennessee, a lot of people got priced out.
I hear Tennessee a lot recently.
People got priced out of Nashville, so they moved to Memphis and other cities that are, within reason or it's easy to get it to. Colorado, so like Denver, still very big, and it just keeps
Denver's
spreading
expensive.
out.
Yeah,
Denver is expensive, but people are still building there. Areas like Utah, we get a lot of requests. California, people are getting priced out. So California,
Utah, I'm surprised. Yeah.
Utah, popular state.
Really?
Yeah. California, so you see like Sacramento was a big city. People, it was a good price point, but land outside of it now people are building. Texas, almost anywhere in Texas, from you'll be in like Dallas, Fort Worth. Austin is still popular. You see sub areas of Austin now. So Austin, big city, outside people are buying land, building single family homes.
So, and you find the primary reason is affordability from the end user's part? I
think it's affordability. I think also, we were discussing this earlier, and a lot of like people can work remote now, so you can be a little bit further or outskirt of a bigger city. They'll provide housing there where you're still close to a city where you don't have to create a new city, so you could still use like city infrastructure.
Gotcha. And how do you see, by the way, that trend going of remote work? Because everyone thinks it's going to be like commercial apocalypse, and we're going to have to convert all these buildings into residential, and that's going to be a whole new market in itself.
I think based on New York traffic recently, I think it's trending more people going back to office. I've seen a lot of companies, I don't know if it's a productivity issue, but I think they feel like they want more people to come in. Trains have been packed again, streets, traffic. I feel like there is a trend of more people going back to the actual office.
I agree. I mean, we're all in the office these days, with the exception of a few here and there. But I prefer to work in an office personally. I prefer to like see my team, and it's difficult. Maybe it's different because in one way we do work in sales, right? Technically, we're in sales, so it's like you kind of need that camaraderie. Maybe it's different if you're just a paper pusher, but like I don't know how you can run a company efficiently if the entire company is remote.
So we found success with remote employees, and they're great because it's probably talent you couldn't have found around here. But I do feel, especially for sales, I do feel like there's sales team feeds off each other. Yeah, it's in the office. I think it creates team
little
building.
Jabs and
little jab.
Talking.
Yeah, like I got this signed up. Like where's yours? Yeah. I think that builds it up. I think team building. I think when people are able to see each other and even just walk past each other 5 minutes by like a water cooler, grab lunch with like a new teammate, and we encourage that. Call someone that you haven't spoke to in the company that you don't know.
Oh, cool.
Those are big things that we push on like our weekly calls. I think it's important. Like you know, a lot of times people think it's a 9 to 5 and they forgot about it, like being home. I think that team aspect and people working together and creating relationships at work is great.
What do you think is like the number one thing that has worked for you when it comes to team building? And I'm asking selfishly as someone that's also looking to grow my team and make sure everyone's fired up, so to speak.
So lunches or happy hours, slow days.
Like happy hours all day.
Yeah. All day. So pre-holiday. I think I heard a ping pong table in your guys' office.
Yeah, we're a little bit crazy with that.
I think that's a great idea. We're adding a foosball table.
Oh, cool.
I think even that are people usually rush out of office at 5:30, but if they know they can like have a beer, hang out, play a game with each other, or say, hey, we're going to order some wings and watch the football game. So we're going to do Thursday night football in the office soon.
Oh, cool. Good idea.
I think people want to hang out. I think it's fun. I don't think everyone's always in a rush to get home if there's an event.
Yeah. Yeah, same here too. Like sometimes, like a few people in the company will leave at 5. The hours are split depending where you work on. Sometimes people will leave at 5, 6, or 7. So anyway, the people that leave at 5 or 6 will often be here for an hour or two after because they're like sweating their ass off, like in a heated ping pong tournament, like smack talking. And usually one of them. But it's fun, man. It's fun, and ping pong's a great one for sure. But I feel happy hours as well, fantastic. And you do, Mike, a lot of events as well, right? Because you travel, so you do a lot of sponsorships. Is that mostly in New York, or are you going all over the place?
So we're going all over the place. Sharestates is national, so we fund loans in 44 states.
Oh, wow.
We do go to the conference nationally, so you see a lot of them now. I think like Vegas must be giving away free exhibiting halls because every conference is there. But we go to other places. We do host like events with clients in other states. I think it's always fun I think it's great to meet your client, like a lot of the business now, but it's cool to shake someone's hand, close 5 loans for you, 6 loans for you. Love to see your projects. Stuff like that.
It's true, yeah, because we're just like at a desk away. We don't actually see. We just finance it at the end of the day. It's nice to actually see what we've contributed to. I find it fulfilling.
Yeah.
Right? Because it's easy to kind of get lost in the numbers and the day-to-day of just growing, where also in your role, Mike, I don't know if you're more hands-on with clients as time has gone on. The way that I run my business, I essentially am like the first point of contact with my clients, then I'll speak to them once to maybe 4 times until the very end of the transaction, and my team rolls through the rest. But that's something that I genuinely miss. Like, I miss talking to people and actually because it's fulfilling, right? It's not as fun.
Yeah, that's actually what people ask, like COVID, like what do you miss the most? I did miss the conferences, and you would meet someone that would become like a lifelong friend through whether it's like you're all waiting for a networking event or you got to the event early or you're at the bar having a drink. And I think those meeting in person and shaking hands build like these long relationships that have been amazing for us.
Which is another reason why I'm against the remote stuff, right? Because you don't really get it, right? If I'm working from home, I'm not inviting someone over to go through their loan or talk business. I'm going to do it at my office or a safe public space. Even like I get people that invite me to come to their home. If I don't know someone, I'm not going to their home, because you never know. Plus, if you watch, Jeffrey Dahmer or whatever, you just get you watched it?
Watched it. Nuts.
I'm only 2 episodes in, but a little crazy. I thought it would have been more disturbing, honestly, because a lot of people said you can't even get past the first episode. Which, don't get me wrong, was disturbing, but I guess I expected more.
Don't worry, it'll get there.
Yeah.
Yeah. Oh yeah.
Yeah, that's good times. Maybe I'm I'm numb to it because we've seen so many freaking serial killer documentaries at this point. And thank you, Netflix. Thank you. Thank you. So, okay, so where were we? We were talking about remote work. In terms of the trending over the next couple years, I personally think that business is going to be very slow over the next 6 months, at least on the residential side. And then rates will drop, people will refi, the market will stabilize and kind of go back to normal. So I don't see it really getting good until Q2 of 2023, but I would like to know what you think on the investor side. Where's it going to go, both short-term and long-term?
I think investors in general, I think certain markets, I think they're going to continue to build. There hasn't been like a dip in prices everywhere. Certain places are still going over ask, or there are bidding wars. People are buying them. But I do agree with you. I do think you're going to see a big slowdown from now till probably March, April. I think the market needs some sort of stabilization. Every time you issue a rate or a term sheet, by next day, if the person doesn't sign it, it could change. And like what happened, I was like, can't really explain this one. But I think once that stabilization hits, you might see business a little bit of normalcy. I don't think you're going to see that rush we saw, like where with rates in the 2, where everyone was active.
I don't think they're going back to the 2s.
But to create business and make a lot of these deals work, whether it's on cap rates or on rent growth or any of that stuff, the exit rate doesn't work with some of these higher rates. A lot of these deals won't work, and it might stop either growth or building and all that. So I do think we'll see adjustments like you meant, but the next 6 months, I don't think it's going to be as crazy as maybe the last 2 years.
So for the investors that are kind of like sitting on the sidelines, waiting to see how things go, right? What advice do you have for them? Like, do you think they shouldn't be sitting on the sidelines or just buying intelligently?
definitely buying intelligently. I wouldn't say sit on the sidelines. I think some of the wealthiest people were created during turmoil.
Yeah.
So there's always opportunity in markets like this. There's a big thing right now. People say like, oh, the rate is too high, or I'm not going to pay that rate. I think that's a crazy concept in someone's head.
I agree.
If you're buying a property and you know the spread's there, even if the exit price is lower than what you anticipated, you shouldn't be concerned on the rate. If you're doing a bridge loan at, let's just, to use like raw numbers, at 12%, and it's a 1-year loan, if you sell the property in 6 months, you paid 6%. Yeah. That's much cheaper than dealing with having a partner or anyone else. On a DSCR loan, so like the non-QM, you're looking at the debt service coverage ratio. Yeah. If you're in the middle of the country and your DSCR at 8.5%, is still hitting like 1.5%, what does it matter? You're still above what like the original threshold was of hitting 1.25%. So like, why wouldn't you take the loan? You take it, market gets better, you refinance. A lot of seasoned investors I've spoken to, they said a lot of the deals that I made the most money on is I bought when the rates were the highest. I bought them at the highest. I was able to refi out 3 to 4 years later, and that's where I made my money 3 to 4 years later. But the best deals I got were in that time.
And I think that's also lenders and media's fault for just pushing the importance of rates so much. So like I was saying 2 years ago, the government is my favorite hype man because they made us so busy over the past couple of years through QE and buying MBS, and it's just freed up the market and everything got so cheap. But it has this full sense of importance or how important the rate is, right? Because I'm with you 100%, Mike. Like, you're better off buying with a higher rate and a medium price or a lower price, whatever it is, and eventually refining, or even for people who are just like waiting for rates to drop when they're renting and paying $4,000 to $5,000 a month in rent, or even less, right? It doesn't make any sense, right? You're still wasting money, so to speak.
Yeah, so similar concept. If you own a pizza shop and the cost of flour goes up, do you close your pizza shop, or you adjust prices? You make it work, and people adjust. Some places took down the 99-cent slices.
It's $1.25 now.
$1.25. Right? The signage got weird. Yeah. But you got to adjust your business. Look at the numbers and just. You're not going to find a deal maybe as easy as you would have, but you're still going to find deals. They're out there. You have all the foreclosures, the bank REOs, the short sales that were on hold through COVID that you can find good deals on now.